Well, welcome everybody. I'm Rich Harvey, CEO of Propertybuyer, and welcome to our webinar today. I'm delighted to introduce Mark Stevenson from Bell Partners and also Kieran Argall from Bell Partners. He'll be helping me today with our webinar, talking about using investment property to build your wealth to retire earlier and safely. So I hope you got your pens ready. We will be providing a recording of this along with our notes. So feel free to sit back, grab a cup of tea or coffee and enjoy your lunchtime break while we get through this. So I'm going to hand over to yourself, Mark. You're going to introduce the finance angle, then I'll be talking about the property market, and then finally Kieran will be talking about some of the tax implications of how you can be smarter with your money. So Mark, over to you. Please take us away and give us some insights into finances, please. And if you'd like to share your screen, thank you.
Good on you, Rich. Thank you very much for that and appreciate the opportunity to be part of this. So if we practice this right, you should be able to see my screen at the moment.
All good, mate. Yep.
Okay. So yeah, essentially, we're going to cover similar topics from a range of perspectives. Obviously myself from the financing side of things, Rich from the property side of things, and then Kieran from the accounting side of things. Just as a, the most important thing, Kieran will cover a bit of this in terms of the finance and debt structuring from an accounting side of things. But it's also an important topic for me to cover from the finance side of things as well. So I think the biggest risk of getting your structure wrong is probably not using trusted professionals. And probably the worst thing you could do at the moment is just going direct to the bank. But, again, you're probably listening thinking, well, I'm a broker, so of course I'm going to say that, but there's a little bit more to it than that. So from the 1st of January this year, off the back of the Royal Commission, came in RG 273, which is an ASIC legislation that covers mortgage brokers. It's commonly known as the best interest duty. So what that is essentially it's legislation that says we must at all times act in the best interests of our clients, which is ahead of our own interests or any other party, which could include a bank or other third party. So look, as a broker, and I think most brokers are the same, we've always acted in the best interests of our clients. That's what has caused such growth in this industry. But now it's enshrined in law. So the flip side of that, I guess, is you're looking and you go, well, banks and lenders are actually not covered by this legislation. So there's no legal requirement when you walk into a bank for them to put your best interests ahead of their own. So I think the best way to do it is pretty simple. Is just go and see a good broker. And I think, it does reflect in the numbers, but when I started in broking, it was around the 40% mark of all new lending was originated through this channel. And the most recent figures out from the Mortgage and Finance Association have us at about 2/3 of home loan lending coming through the broker channel. So in terms of getting an optimal outcome, I think, if you've had recent experience with bank staff, and we do it on a fairly regular basis, many times in a day, whether it's over the phone or if you have a dedicated bank, you'd be familiar with how narrow their field of vision is when it comes to what help they can offer. As brokers, we're fortunate we get to deal with dozens of clients and scenarios every week. Over a 6-month period, we're probably at around 15 to 18 different lenders that we'd work with over that period. So we're not sort of funneling all business into one or two lenders. So we've got experience with getting the optimal lending outcome for our clients. But the other side of that, it's really essential that we work closely with professionals such as buyers agents like Rich and with Kieran on the accounting side, financial planners, just to ensure what we're delivering is actually in line with your overall financial strategy and goal. Because, I can come out and deliver you an outstanding loan solution, but if that completely upends the effectiveness of your tax or wealth plans, it's not an ideal outcome. So aligning your debt structure with your overall wealth strategy definitely prevents unexpected problems. The other important thing about getting your finance structured right is debt portability. So as a first option, banks will generally structure your debt in a way that best suits them, and in a way that generally will make it harder for you to move. So it could be cross-securitization of loans, interlocking business and personal banking. They're probably the two most common ones we see where we are. I think thankfully gone are the days where the client feels they need to stick with the one bank their entire life. I remember when I bought my first property in my mid 20s. I'd been a CBA client since joining Dolomites when I was about 5 years old in kindergarten. And I rocked up into the North Sydney branch, very green and not sure what I was doing. And I spoke to the home loan lending person in there, and I actually asked the question. I said, like, do I get any sort of preferential product or treatment or anything for the fact that I've been with you guys for the last 20 years? And they pretty quickly just said, anyone who walks off the street, whether you've been with us since a Dolomite or you've just walked in today, is going to get the same service. So I think it's common these days and pretty acceptable that, home loan borrowers will move lenders potentially every 3 to 5 years. But having said that, it also needs to be done with some level of care, because there are costs associated with moving. So there's lender fees, government fees. And unfortunately, I've seen, I guess I'd probably call them rate chasers, that are just always looking to move to the next cheapest rate they see. And they can actually get stuck, and they would have actually paid off their home loan a lot faster had they just gone with a good lender and just stayed with that lender. So I think when you're speaking to a broker or a banker, I see it as it's my first and probably most essential job is to get a really good understanding of people's circumstances, needs, goals, future plans, just the overall strategy. So then we can make sure that we're not locking you into a lender or a product that's going to cause any restrictions to those future plans. Because the last thing you want to do is, we get you in with a lender that looks great today, and then you go to do the transaction you were planning to do in 9 to 12 months time, and it all unravels and becomes a nightmare. So, the other advantage for us is that we work with our clients over the long term. So it doesn't really matter so much if their banker changes or if they need to move lenders. You're not in a position where you're having to retell that story every time you walk into the branch and speak to a new person behind the counter. And I think the last thing is just around lender knowledge, and good professionals like Rich and Kieran will encounter enough of this stuff to have a general idea, but it's really important to know what the lender's products are, detailed information around those products, their policies and processes. At the end of the day, we want to make sure we match you with the right lender that meets all those needs and circumstances. I really feel for the people. Occasionally it happens where we'll have someone that's come to us after having a go on their own. They might have been to 3 or 4 lenders. You can see they're fairly battered and over it. And it might have just been that the next bank down the street was the one that they would have perfectly matched all their policies. So just that unknown, if you don't know what you're doing, it can be a bit of hit and miss. So just quickly, I wanted to touch on finance pre-approvals because I know they get mentioned a lot, and just to give you some information around how they actually work. I think the most important thing is that you have one. So, often buyers agents like Rich will ask you the question, do you have your finance in order before they want to start working with you? It's not just to stop them wasting their time, but it's to stop you having problems down the track as well. So, not all pre-approvals are the same. So there are lenders out there that just give essentially what's a system generated pre-approval. They check some basic parameters. As long as you don't get any red crosses, they'll issue a pre-approval. The problem is they're not really worth the paper they're written on. And you can run into trouble down the track when they get looked at in full. The kind that we prefer is a fully assessed pre-approval. So that's where it's been through a credit process, and assessors looked at it, they've signed off on it. And essentially the only things you really want it subject to are a signed contract of sale and a satisfactory bank valuation of the property. So that way, if you go to an auction or you're putting an offer in on a property, you can put yourself a step ahead of people you're up against with your finance in place. And with the timings, again, I think it's important that you don't go and there's 2 ways to look at it. You don't want to go and seek out a pre-approval a week before an auction. Even if you had everything ready to go straight away, it's likely you're going to only have a choice then of 1 or 2 lenders at best because of those timing constraints. Not many lenders today can turn around an application in under a week. And it just means it's not ideal. You don't have as much choice. A 2 to 3 week lead time is generally good. It gives us enough time to find the best lender. If there are any wrinkles, we've got some space to iron those out. We can prepare and lodge the application, and it gives the bank's credit team time to run through their process. The other side of things, I guess, is pre-approvals are generally only valid for 90 days, and then a lender's going to want a whole new bank application from you. So by giving it sort of 2 to 3 weeks out prior to when you'd ideally be signing a contract of sale is about right. That's kind of going to maximise the time you've got without wasting time going through multiple pre-approvals. We do get the odd occasion where a client turns up on a Monday morning with a contract of sale they've signed at auction on Saturday, and it's certainly not an ideal situation. We always do our best and hustle on it. Most cases we find a solution, but I have seen the reality of what happens when clients get stuck out and they're not able to secure finance, and it can become very expensive. It can become a hundreds of thousands of dollars problem if it's not done properly. So just onto rates, getting the rate right. I had to fix or not to fix, that's the question. It's a really common conversation. So rates are important, but they're definitely not the only thing you want to be considering. I think, if I had $1 for every time a client came in saying, but my neighbour told me they got this rate or the bank was going to give them this much, how come I'm not on that? I think I'd probably have enough to start lending out my own money. The other thing is online. There's a lot of bait rates out there where a lender will throw a rate out online, put it in really big bold writing, and the devil on those things really is in the detail. So our job is, I guess, to look at your circumstances. It could be down to your income, the deposit you've got, or the equity in another property, the type of loan you're after, be it owner occupied or for an investment property. The type of repayment, whether you're on interest only or principal and interest terms, fixed variable rates, what bank policies are and what you qualify for. There's so many different moving parts in terms of getting the right fit for purpose. Just this graph here is data off the RBA that I just wanted to throw together. What it's doing, there's a few lines on this one and I'll break it down, but I wanted to give you the whole thing just so that when you've got the slide pack, you can actually have a good look at it. But essentially what it's doing is we're showing the standard variable rate average across the banks, the discounted standard variable rate. So what banks promote as a standard variable rate is very often not the rate you'll get. Just about all banks now offer a discount to their standard variable rate on most products. So they're the sort of two, I think the discounted rate is probably more relevant because that's the one you're going to end up getting from the bank. The 3-year fixed rate there, I've put in, it's a good middle ground for fixed rates. The 3-year tends to be the most competitive most of the time. I've put in there what the quoted fixed rate at the beginning of the loan terms would have been. And then I've also pushed it back out, that rate 3 years later. So obviously if you take that rate out today for 3 years fixed, that's the rate you're paying in 3 years time from now. So if you draw a horizontal line between the 3-year fixed rate start rate, which is the gray line, and the yellow orange line, which is the end rate, that kind of shows you that's the rate you're paying over that period of time. So just first I've taken out the standard and discounted variable rates, just to have a closer look at those. If you have a look there, you'll see, so the average discount in June 2004 was about 0.48%, so just under 0.5%. And that, rates then at the time up in the sort of high sixes, low sevens. It was about just under a 7% discount on the standard variable rate, where if you fast forward to today or February 2022, the average discount 1.07. So they've pretty much gone up by over 2%, over 200%, more than doubled what they're discounting the rates by. And that's what we've seen, as you can see there with the line towards the end. The standard variable rates are very much sat flat. The only differentiation is where banks are discounting those rates on a case-by-case basis. So, and again, it's forming a much larger proportion of the interest rate. Like we're looking at standard interest rates discounted at about 3.45%. So to have a discount of 1.07 off that, that's close to a quarter of the overall rate is being discounted. And that makes sense. Like I don't see many people come in with a 3.45. I think if you're paying 3.45 at the moment on your owner occupied home loan, you're probably paying too much. This rate graph here shows the variable rates to fixed rates. So this is kind of saying, well, if I was, what am I missing out on? If I take on a fixed rate, what have I missed out on or gained by not being on that variable rate that can shift up and down? So I think the most important thing to remember is you're never going to beat the bank on a fixed rate loan. The bank, it's not a win or lose game for them. They've secured the money. They know what the cost is. They've built in their margins. So when they're lending it out to you, they know how much money they're going to make off the transaction. So, and then what they do is they put in extra rules and say, look, if you deviate off any of these rules, we're going to charge you break fees and charges, which will essentially compensate the bank for the budgeted profits they were planning to make. So if you'd fixed your loan for 3 years around that middle of 2008 period, in June 2011, so towards the end of your 3 years, you'd been paying over 2.25% more on that fixed rate than you would be at the same time on a variable rate. And it makes a big difference. On a $500,000 loan, that's probably looking at just under $1,000 every month in additional interest. So it's extra cost by being on that fixed rate. And it was actually worse. That was, in that period of 07 when rates were increasing. There was talk of them hitting double digits. Thankfully, they didn't. They topped out in the 9s. But people were taking 5-year fixed rates at that time in the 9%. So we were dealing with them sort of, 2013, when variable rates are closer to 5%. You've got these people locked in at 9%. And the bank's charging potentially tens of thousands of dollars for them to break those rates. So, look, generally speaking, I think with falling rates, as we've seen since around 2011, that variable's going to win. And the fixed rates, look, you can win when rates are rising, but it is really a case of the fixed rates lead the variable rates out. So by the time you notice variable rates are starting to creep up, which there's a lot of talk about happening this year, as we see now, fixed rates have already jumped up. If you haven't been on top of it, probably for about the last 3 or 4 months, fixed rates have been increasing. And if you were to go and lock in a fixed rate now, you'd be paying a premium to the variable rate. And you got to make that call about, is it realistic over the next 3 years that there's going to be 6 full 0.25% rate increases by the RBA as to whether you're going to end up any better off or not. So I think the most important things to know about fixed rate loans is they're usually for a relatively short period, sort of 1 to 5 years. They do come with those restrictions. So it's things like they'll restrict your ability to make additional repayments. Many lenders won't let you have an offset account linked to a fixed rate loan. If you wanted to refinance or alter that loan, there's potential break costs. There are some lenders out there who market a niche that they'll allow those things on a fixed rate loan, but their products are normally more expensive. So you'll be locked into a higher fixed rate than you would have been with another lender. And it really does get to the point where the break fees will outweigh any benefit if you need to break a fixed rate loan. So if you're locked in and you needed to break it in that period, chances are whatever you thought you were going to save by locking in a low rate, you're going to lose that benefit once you pay the break costs to the bank. The other important thing, which again, a lot of people don't understand, is when you fix your home loan, you get given the fixed rate that's quoted on the date of settlement. So a lot of people think, well, hang on, I applied and the rate was, 2.2% fixed, and come settlement it's 2.7%. That's the rate you get. You can rate lock, which comes with a fee, varies usually 0.15% of the loan amount or $750. But they don't actually allow that on pre-approval. So it's only on if you're going with a full formal approval that you can take out that rate lock option. I think the main reason to fix really is just certainty of repayment. So if it's for budgeting or cash flow, and as long as you know that you're going to be able to see out the fixed rate term, so if it's a 2 or a 3 year fixed rate period, you don't intend to sell that property or there's going to be a reason to move lenders. That's a good reason to do it. Reasons not to fix is if you are going to need to or potentially need to restructure your debt or move during the fixed rate period. So we're not talking the next 30 years, just that fixed rate period. If you're intending to or you're likely to have cash to either repay the debt in full or partially offset that loan, it's another reason not to do it. So I think the most important things to consider when you're choosing is just your ability to absorb any variations in interest rates. So, you know, if you've got a bit of a buffer that if variable rates were to increase or move, that you could absorb that. Any plans you have over the fixed term that might require you to restructure or move to another lender. Looking at how much you've got in savings to offset interest, including any upcoming lump sums if you're expecting a cash windfall. You know, if available, you know, which property you're going to use to secure a fixed loan. So you might take out a fixed loan and stick it against a property that you know you're not going to be needing to transact on. That's going to save you problems versus putting it onto a property that you may transact on. And obviously we don't have any ability to foresee what interest rates will do over the fixed term. So, you know, we try and focus just on the things that we know and we can control. With the other option again is into a fixed variable split loan. So we do a lot of these where, you know, fixed rate might be appropriate for a client, but we want to carve out someone a variable split so they can offset against it or pay it down faster. Some people are lazy and just do the sort of 50-50 split method, but we try and be a bit more scientific than that. Our general rule of thumb is, you know, how much money have you got to stick in an offset today or post settlement of the transaction? What your propensity to save will be like once the new loan's in place. So if it was a 3-year term and someone said they could realistically save $1,000 a month, we'd go, okay, well, there's potentially $36,000 there in savings they're going to accumulate over the fixed rate term. And then any other windfalls or lump sums we try and add in. So if someone came and said, look, I've got 20 grand now, we'll save $1,000 a month over the next 3 years, and I'm expecting an inheritance of 20 grand, we'd probably go 20, 36, you know, we're up there at, you know, 76 odd thousand. We might round it up to 80 or $100,000 just to give a bit of leeway as to carve that out, leave that as variable. And then we'd reassess it at the end of the fixed rate term. The last thing I had there was just in terms of maximizing your borrowing capacity. It's probably a question, you know, the most common question we get asked is how much can I borrow? If I had here, if nothing changes, nothing changes, but it's not actually the case because really across the lenders that we operate with, we've got 40 odd lenders. They all assess it differently, and you might only be able to borrow, you know, it could be $400,000 with one lender and 700 with another. Like it can vary quite a lot. So looking at that based on your current situation, earning more is obviously another way to do it. Again, that's not always within our ability to control that. It can be limited. So, but again, you know, essentially the more you earn, the more you can borrow, all else remaining equal. For self-employed clients, which we do a lot with, it can be in conflict. Obviously, there's minimisation of tax on one side and maximisation of debt on the other, and they can work against each other. Reducing liabilities is an important one. I think that the number one thing there I'd probably say is that don't jump the gun and start cancelling credit cards or reducing limits before you've spoken to anyone, because we can usually guide or advise about what needs to be done. It's not always essential. It may not even help. And it's just a hassle to go and reopen credit cards. Yeah, the other thing as well with the liabilities now is that there is positive credit reporting, which means that all your facilities now are all live. Current facilities are recorded on your credit file, which means a lender can come in and actually see your last 24 months worth of repayment history and all the current accounts. Second last, just general living expenses. We've got, you know, most lenders will use either the Henderson Poverty Index or the household expenditure method, or a combination of the two in their own calculations. They ask for a breakdown across a lot of different categories, usually verified with bank statements. So I think the idea is if you're going to be planning ahead to getting a loan application in to maximise the borrowing capacity, you don't want to be spending a lot of money on discretionary items because that could work against you. Deposit is obviously a big deal. So the D factor was the deposit there. So the bigger deposit you've got, it's going to make a difference. If you're less than a 20% deposit, you're not only assessed by the bank, but you're also assessed by a mortgage insurer. And you're going to get better rates as well if you're under that 80% LVR. And the other options, just sort of thinking outside the square, the things that we usually use is a common debt reducer, which a couple of lenders offer. It's where if me and my brother own a property, the bank will only use my half of the debt rather than taking the whole debt against my name. There's additional borrowers. So again, at time to time, we'll add someone else onto the loan, but there's got to be a benefit to them. They won't just add someone on with no benefit. And we get asked it occasionally from time to time is about a security guarantor. They don't, sorry, a serviceability guarantor, and they don't really exist these days. So if you've got parents that make a lot of money or a brother that makes a lot of money, the bank won't use their income to help service your debt. In the past, it was something that was available, but not anymore. So that's me done, Rich.
Well done, mate. I've got to say there's a lot of great info in there, Mark, and thank you for sharing that with us. Really appreciate it. And there are a few Q&A. I just want to say to everyone, there will be a time at the end. I'm going to be about 20 minutes and Kieran about 20 minutes. We're going to allow about 15 minutes at the end for Q&A. So please pop your questions in the Q&A box, and we will answer each one as best we can at the end. So please keep them coming, and we'll come back to them. So yeah, look, I'd love to share with you now some thoughts on the property market. And I'm sure a lot of you are logged on today to ask a lot of questions. Is now a good time to buy? You know, will the Ukraine war really affect property prices? And what about the bank forecasts, etc.? So let's rip into all of those questions and more as we go through. So just a quick bit about my business. A lot of people are here from my own database, but for those who don't know me, I've been running propertybuyer for 20 years. We've purchased over 3,500 properties. I've also contributed my time on a voluntary basis as president of REBA and the chairman of the Buyers Agent chapter. I'm also a fully qualified property investment advisor. So what I'm going to cover off today in the next 20 minutes is just this question: how many properties do I need to retire on 150K? Is now a good time to invest and look at some forecasts? Resi versus commercial. And what sort of criteria should you be looking for in your next investment property? And if we've got time, I'll go through a few case studies as well. So I hope that sounds exciting for everyone. All right, so how many properties do you need to retire? Well, in fact, it's the wrong question. A much better question is, what investment strategies do I need to implement to retire on 150K? So if you ask how many properties do you need to retire, and it could just be one property, or it could be 10 properties. But it's about the value of those properties. A lot of people are just getting hung up about how many properties do you own? Well, that's irrelevant. It's more about what's your net worth and what cash flow are they throwing off, and how much gain are you getting every year from your whole portfolio. So the things I look at when I'm talking about a client strategy is I do these things. I look at the client's goal, just like a financial planner would sit down with you and ask you, what are your key goals in life? What are you hoping to achieve? And how can you get there? So you've got to have a goal, a strategy, then you consider the area, and then the property. A lot of people get confused and get it all the wrong way around. They jump on realestate.com and go, hey, I've got 600 pre-approval, what can I buy? Rather than thinking, what kind of strategy is going to help me achieve my goal? So let's have a look at I guess, a very broad estimate here. And again, I've done very, very simplistic assumptions. I know you're going to shoot me down and say, Rich, you forgot the decimal points, but look, just come with me on the high level concept here. Let's say you want to have a goal of $100,000 of passive income. So how do you achieve that? Essentially, you've got to start with the end in mind. So if you want to have a net goal of 100K, and then working off, say, a 5% yield, you need to have $2 million of unencumbered property. So 2 million times 0.5% as a yield gives you your 100K. Now, that's assumed you've paid the debt off over that period of time. So I've got a little table here just to explain it in a bit more detail. So pick your desired income, work out what the net value you need to own unencumbered, and then I've simply doubled it. And then you can work out based on how many properties you need to accumulate for each one. So if you want $125,000, assuming a 5% yield, you need to have $2.5 million in unencumbered, that's no debt property in your portfolio, and that'll deliver you your 125K. How do you get that? Well, you've got to buy potentially 10 properties at 500K each, or it might be, 5 properties at $1 million each, and then gradually pay the debt down on those properties, or perhaps sell 1 or 2 of those properties as you approach retirement to get that net asset down to 2.5 million. Now, look, there's lots of assumptions in there. You've got to talk about holding costs and maintenance and everything, and that will obviously reduce your gross yield to a net yield. So you may end up needing, obviously, to have more in your net pocket at the end of the day. So my simple formula is this: capital growth plus yield or cash flow equals financial independence. Everyone has the goal of, having more wealth, I believe, because it gives you more choices. Won't necessarily make you happier, but it certainly gives you more choices in life. So in building my own portfolio, I just thought, what are some of the things I've learned over the last 25 years in building my own portfolio? And a couple of things that come to mind is it's about the value and the quality of your property portfolio. It's not about the number of properties. I've generally found that houses perform better than apartments. I have owned apartments as well, but my houses have tended to perform much better long-term, both from a yield and a capital growth perspective. Cash flow is critical for borrowing. Now, I'm going to get 2 thumbs up for Mark for this point, because the banks love cash flow, right, Mark? Give me the 2 thumbs up for that, right? Yeah, absolutely. Because unless you've got a job and you've got cash flow coming off your properties, the more cash flow, the more money generally the banks will lend you. And as Mark's indicated, getting the right finance structure is absolutely critical. I saw someone's put up a good question there about building a whole portfolio of 10 properties, and that's a great goal. But getting the right broker on board, getting the right structure is critical to being able to refinance and minimise your borrowing costs along. And this line, revalue, rinse and repeat, that simply means as you buy high growth properties, pulling out the equity, rinsing that out, using that to leverage, and then repeating the process again is something we do every day of the week. All right, so that's enough about strategy. Is now a good time to invest? Now, I'd love if I got $5 every time I was asked this question. I'd probably have $500 in my account at the end of every day. And the answer is it depends. It depends when you're ready. I'm personally buying right now. Even though I think the market has hit peak price growth, it's still a good time to buy, simply because I'm seeing that rents are rising very rapidly. I'm going to have less competition when I'm out there buying for my portfolio. I'd rather buy this year while I've got capacity to buy, because who knows what's going to happen next year. I'd rather buy when I've got a pre-approval, knowing I could buy well and hold for the long term. I'm not a flipper. I tend to buy and hold in my portfolio. So why am I saying buy now? We're seeing buyers getting more choice because listing volumes are increasing. We're going to have a rental crisis later this year and next year as more people are chasing rentals, and there's a very severe shortage of supply coming. And as I said, a softening market means a lot of buyers sit on the fence, thinking that the market's going to drop too much. So here's the actual figures from CoreLogic from their latest monthly updates. Listing volumes sort of not too bad compared to the same time last year. There's still, this time last year, the new listing volumes were down about 30% and demand was up about 25%. So you had this massive imbalance between supply and demand last year. But we are starting to see more listings coming onto the market, and we'll see more and more as we go through the year. On rentals, as you can see, huge spike here in rental prices, and this will continue to climb, I believe. SQM research just came out, I think yesterday or the day before, suggesting we could see an annualized increase of almost 15% in rents. Obviously very difficult if you're a renter, great news if you're a landlord. So yeah, just watch the rental space. It doesn't mean there's going to be a 10% rise in every area, but certainly in the right location, that if you buy well, you should be expecting to talk to your property manager about increasing your rent appropriately. Now, another reason I think you should be buying is we are moving into a phase of the housing cycle where dwelling approvals for houses and units are trending downward quite significantly. We've seen a couple of big builders like ProBuild go into administration, big issues over fixed price contracts. That's going to wash out, but we are heading into a phase where there's going to be a shortage of stock yet again. The last 5 years, we've caught up a lot, but we are absolutely heading into a position now. And the head of Mirvac actually came out the other day saying we are very much going to have a shortage of supply. And if you read my latest newsletter, I've got a lot more stats about why I believe that's the case. The other key drivers for me in why I'd be buying now and investing is simply these 11 factors. We have a good resilient economy, which is rebounding. Low unemployment. We've never seen unemployment figures so low. Now, household balance sheets are up significantly. So many of us have saved money during COVID. and that money's going to be spent somehow. It's either going to be spent on perishable goods like TVs and jet skis and cars, or you can invest it into, good assets like housing and save for your future. Low interest rates. Yes, interest rates will rise, but I believe they're going to stay still very, very low. I think my personal opinion that we call the natural rate of the cash rate is probably going to sit about 1.25 to 1.5%. You're not going to see it jumping up to a 3% cash rate. We've got ultra low vacancies. Students and foreign workers are coming back in. As we said, building approvals are slow. Now this one, number 8 here, buyers chasing lifestyle. This has been a massive factor with COVID. So many buyers want to upgrade their digs and move to lifestyle coastal areas, or just where they don't have to commute to work and they just want to choose lifestyle. So that's a big factor and a big shakeout that's going to continue in the housing market. And you can read the other factors there at your leisure. So for me, investing in housing is a long-term thing. So this doesn't have the most recent spike here. I've got to get an updated chart, but I want to just take you back to the 1960s. And if you look at all the periods of time when we've had a downturn in the market versus an upturn in the market, you can see that the downturns, they don't go beyond 10%. When negative gearing was proposed to be removed, we saw a dramatic drop in the market there around 1987. But most of the drops have been averaging 5% or less. So even though some of the banks are forecasting 8-9% drops, I don't believe we're going to have as big a drop. Banks are notoriously terrible forecasters because they're all economists. So yeah, for me, it's about taking a long-term view of the market, not a short-term view. Okay, a couple of key questions here. Resi versus commercial, which is better? Well, it's like asking me which of your children do you prefer? I love them both. But look, you've got to learn to walk before you run. You've got to get a buffer in place before you buy commercial. And the reason I say that is that with commercial property, if you have a vacancy, you often have a very long vacancy. It's not a couple of weeks, often it's months or 6 months, depending on the type of commercial property you've bought. If you're going to buy commercial, it has to have multiple uses. So another tenant, commercial tenant, can come in quickly and replace the lost income you have. Even during COVID, we saw a lot of really good long-term commercial properties sitting there vacant. And those poor landowners, landlords there, were getting no income. So it was a very, very difficult situation. And that's why the banks generally a loan to value ratio will be 70%. They see it as a riskier type of asset. So it's important, if you are going to buy commercial, to get very long leases, a very good quality business, and have a commercial property that has multiple uses and can be easily fitted out. So look, we have a commercial buyer's agent on our team, Alberto, who does an amazing job. And so yeah, look, I would suggest that you get 3 to 4 resi properties in your portfolio or more before you start considering buying any commercial properties. So what should you look for if you're buying an investment property? The key thing I look for are these top 10. I've actually got about 20 or 25, which you can download from my website, but I'm just going to touch on these 10. And if you look at this list, none of them actually talk about the physical attributes of the property. It doesn't say a nice garden or a beautiful lawn or, a tiled roof. Those things are very, very, very secondary to these top 10 things here, which is all about the location and the demographic of the area. So that's why I say when I talk about goal, strategy, area, and then property, that's what I'm talking about here. So we like to look for areas where we believe that there's upside. Very important to buy reasonably close to the median price of an area. You don't want to spend, $2 million on a property in an area where there's a $1 million median price. So normally I like to buy around 20 to 30% above the median. I like to buy a better quality property for the area, because then I'm going to attract a better kind of tenant. I like to buy in areas where there's growing population, it's got the right demographic, lots of infrastructure, good amenities, plenty of employment opportunities. Avoid the mining towns or the one-horse towns, particularly in the far-flung regional areas with small populations. I want a low vacancy rate. I want a good proportion of land content or uniqueness in the property. If I'm buying an apartment, it's got to be unique. Potential to value add, and a high percentage of owner occupiers in the location that I'm buying. So there's some of the key things that I look for when I'm buying my investment properties. These are the key steps to buying well. Obviously, this is a blatant plug for our services. A lot of you have used us already, and we'd really appreciate your referrals. But if you're going to buy a property either with us or on your own, you should do these 7 steps. And number 1 is identify what your strategy is. Are you going for a higher growth or a higher cash flow property? Identify the area that you're buying in, research it well, so you know what you're buying and it's got all the right fundamentals. Then you start searching and shortlisting, finding individual properties. And look, most people just jump to point 3 straight away. Like I said, they jump online, try to find that property without considering their goal or why that area might be a good idea. Step number 4, select the best property, evaluate it, know that you're paying the right price. Complete your due diligence, get your pest and building done, make sure there's no incumbent DAs next door. We're going to build 5-story office blocks next door. Negotiate, get the contract reviewed, secure the property, and then find a property manager and settle it. Most people on their own probably take around 12 months to do that process. We take within about 30 to 60 days on average. And the reason we're so quick on it is, gone the wrong way, is simply we do these things. We just follow that strategy. We get access to both on-market and off-market properties. We aim to negotiate as if the property is our own money and save you as much as possible, and just remove that emotion out of the process. How much do we charge? We have a sliding scale of fees, roughly between 1.75 to 2%. You pay an engagement fee of 3 to 5 grand up front, and then the balance of the fee. Again, all tax deductible as a capital cost for the property. How are we going for time? I don't want to run you short of time, Kieran, so I'm just going to spend a couple of minutes to finish off and just give a few anecdotes. And I'm going to zip through these really quickly because I want to give Kieran as much time as possible to talk about the accounting side of things and the tax implications for building a portfolio. We buy Sydney, Melbourne, Brisbane, Newcastle, Central Coast, anywhere on the East Coast, basically. So Amanda and our team in Melbourne recently bought this in the Bayside area. Really nice property. Got it for under her appraisal. Similar thing, Frankston South, all the Bayside areas we believe has got some good value. Again, about 1 hour, just under an hour commute to the city, but really attractive areas around Frankston, Lang Warren, those kind of areas there. That's not a bad yield for a decent sized house on an 800 square metre block, 745 square metre site. That's one in St Kilda, slightly higher yield, obviously near the St Kilda pier there. She bought that for 660, 550 a week, so giving a yield of 4.3%. But what was nice about this one, parking underneath, but it had a dual level, dual level. It was two levels high. So having that separation of bedroom and living spaces really gave it a nice feel. In the commercial space, Alberto bought a fantastic property for one of our clients on the Central Coast, 6% net yield, and got a fantastic 7+7 year lease. So often unusual to get more than 5+5, but he was able to get a 7+7. So really good, and a 3% increase per annum for an international tenant. So again, often you might need a little bit more cash or money to get into the commercial on these sort of ones, but really good opportunity there. Brisbane is a really bright, shining star for us, for our investors. We're getting strong yields. You can have a budget like this one of 550 for a 4-bed, 2-bath, 2-car. We got this for 525, delivering a yield of 5%. Another one yielding around 5.3. That was a $777,000 purchase. We managed to find an out-of-area agent to nail that one, so we got it a bit cheaper. Also buying in other areas surrounding Brisbane, some of the satellite cities around in Brisbane, where we can get yields of 5.5 to even 6% for houses. Budgets really from 350 to about 500K. So this one we got for 360, renting for 380 a week, giving a yield of 5.5%. Another one, this is a duplex, so side by side, 2-bedroom, 4-bedroom, but 2 beds on either side, and that delivers a 6% yield. So 570 purchase, 660 per week in rent. A couple more expensive ones. Munro and our team did an awesome job in securing this one. We had an investor client with a budget up to $1.5 million. The owner was adamant they wouldn't take $1 less than 1.2, and we got it for 1,185 just last week. So it only took, as I said, only 3 weeks, incredibly quick turnaround in a really high value location. So great capital growth property in the east suburbs of Sydney. I'll just dump through that one. Newcastle's another market that we're tapping into very strongly. Again, this is a townhouse we bought for $670,000, delivering a 4.3% yield. Another one in Newcastle, for just under 800K, and a 4% yield. Also Western Sydney, we're buying houses, adding granny flats or buying them with granny flats. And the last thing we do is also buying properties in the Shire, and lastly, development sites as well. So we've got quite a range there. Look, I've gone through that quite quickly because I want to give Kieran as much time as possible. So please put your, whoops, where are we gone? Just going back to, lost my screen now. Sorry, guys. Stop share. There we go. Kieran, I'll hand over to you, but please put your Q&As in the box there, and I'll come back to you at the very end of the session and answer those questions. So Kieran, I'll hand over to you. Thanks very much, Kieran.
Thanks very much, Rich. Thanks for everyone who's stuck with us so far, and it's not easy for 45 minutes, but and thanks again as well, Rich, for putting this together and organising it. It's really appreciated. Let's jump straight into it. So today, from a tax perspective, we're covering off the biggest tax mistakes that property investors make. How can I legally reduce my tax? And we're going to cover the tax side of debt and finance structuring. So Mark's covered off how to get the money and maximise how much you can get in the rates, and we'll cover off from a tax perspective. So the first one is about apportioning income and expenses for co-owned properties. The first thing to ask really is it joint tenants or tenants in common? So joint tenants means that you own equal shares of the property. So it might be 50-50 for 2 people or thirds for 3 people. Tenants in common means that you can have different ownership percentages, and there's some other implications as well. It might be 60-40 or 80-20 split, for example. If you own a property as joint tenants, just don't forget to apportion the deductions. For example, if you own a property 50-50 with your partner and the interest expense for the year is 20 grand, you can't claim the full $20,000 in your return. Instead, you'd need to claim 10,000 in your return and 10,000 in your partner's return. One of the benefits that a lot of people don't know about when you own a property jointly is it doubles the amount that you can immediately write off. So when you buy a depreciating asset and it's over $300, you would have to claim depreciation each year over the life of the asset. But if you own a property jointly with a partner, let's say 50-50 for simplicity, you can actually immediately write off an asset that's $600. So there's $300 per person. So that's something that a lot of people don't realize they can do. The next most common thing is about land tax and forgetting to register for land tax. The worst part about it, if you forget, and it's been a number of years since you owned the property, and either you work out that you didn't register for land tax or your accountant mentions it to you, or the worst is the state revenue office in your relevant, the state that the property is located in actually contact you. You can get stung with multiple years of having to pay land tax, which can be quite expensive. So make sure when you're buying a rental property that you're actually aware of its land tax value, something you should probably check out when you're doing your due diligence and working out what kind of return you're going to make on this property. Make sure you understand that different states have different land tax rules, rates and thresholds. So if you're considering buying a property, make sure you investigate how the land tax rules work in the particular state in which the property is located. When you're deciding, some people might be deciding between apartments and houses. One thing to point out in relation to land tax, generally apartments will have a lower land tax value since that particular apartment is part of one in a larger block, and they'll divide up the land value between all of the apartments in the complex. And lastly, you should be aware that different states have different rules when it comes to how different entities are taxed. For example, in New South Wales, the tax-free threshold for individuals for the 2022 year is 822 grand. However, for what they call special trusts, which generally covers all discretionary trusts, family trusts, and actually a lot of unit trusts too, there's no tax-free threshold. So buying a rental property in New South Wales under one of these special trusts would mean you'll be paying land tax from 0, of dollars of land value instead of from $822,000 up. So that has the potential to be an extra $13,000 a year of land tax that you'd owe by owning that property in a trust versus owning it in your own name or a company. It doesn't mean that you shouldn't buy property in a trust, just depends on your individual circumstances. So you should seek advice from an accountant who understands the land tax rules. The next one that we've got is about buying a trust because that's what your friend did. You know, you're at a barbecue or something and they mentioned they've got their rental property in a trust and you think that you should be doing that as well. Look, it's important to remember that when it comes to many things in tax, but in particular tax structuring, you really need to consider your own personal circumstances. Don't just use a cookie cutter approach. Just because a trust is suitable for one person, it doesn't mean that it's suitable for another. Trusts can be really powerful from a tax minimization, asset protection, and estate planning perspective, but there can be drawbacks that you should be aware of. So one of them might be in relation to negative gearing. So if you've got expenses from owning the property and they exceed the rental income that you're earning from that property, then your property will be what's called negatively geared. This means that you can offset the loss that you're making on the property against your other income from, say, a salary, a wage, or if you're self-employed, and that will help you to save tax. But what you need to keep in mind is that when your property is owned in a discretionary trust or family trust, the tax loss from the negative gearing is going to be trapped in the trust. So you won't be able to use it to offset against your salary or wage. It doesn't mean the loss is wasted. It's going to get carried forward in the trust to a future year when the property is either positively geared or perhaps when you eventually sell it and make a capital gain. But you could be waiting, you know, a few years for that to happen, and you will have missed out on the financial benefit of that tax saving. And that tax saving could have helped you to save money to buy the next property, for example. So tax savings from negative gearing can be quite powerful. Land tax, we sort of touched on this in the last slide, but just don't forget that in some states, certain trusts don't have access to the tax-free threshold, and in other states they do. So if you've already used up your tax-free threshold, I guess the next thing you should consider is that if you've already used the tax-free threshold in your name, considering whether to buy in a trust or not won't really change things for you, because basically if you were to buy it in your name or the trust, you'll be paying the same amount of land tax anyway. But if you don't have any properties in your name yet, then perhaps you might consider that buying it in the trust would cost you an extra $13,000 a year in land tax. I guess the main thing to point out just with trusts and land tax is just, again, what's good for one person in one state with only one property may not be good for another person in another state with multiple properties. Another benefit of trusts is around asset protection, but you kind of need to weigh up if that's something that you really care about. So some people may have a business or a job where they take on a large amount of risk personally. So if they're a director of their business, they might be exposed to some personal risk, while other people may be an employee and feel like they're exposed to less risk. The person with the greater amount of risk may want to put the property into a discretionary trust for asset protection, even though it may end up costing them more in land tax or it might waste negative gearing. Whereas a person who doesn't have as much risk may not be interested in asset protection and so may be happy to have the property in their own name. And the last thing with relation to trusts is that one person, it's really around the family situation. So one person may have a partner, adult kids, parents who don't work or who are retired, or they might have other family members who they support financially. And another person might be by themselves. So the person who's by themselves, they may not get as much value out of a trust from a tax minimization perspective. And so setting one up wouldn't actually be worth it. Whereas the person with the family could generate substantial tax savings from having the property in the trust if the property is negatively geared or eventually when it's sold. Just one caveat though on this anecdote of using adult kids, parents or family members to save tax via a trust. Late last month, the ATO released a number of guidelines and materials. So I've got them listed there, TA 22.1, D1, I won't go through them, but these came out, and basically it's a complicated topic. It's a bit too big to cover off today. And also it's still in draft at the moment. However, it has significant tax implications for people using trusts to save tax by distributing to family members. So if you already have a trust, or if you're thinking of using one, you should just discuss this new release from the ATO with your accountant or someone who has a good understanding of the proposed guidelines. The next one is about forgetting about depreciation. So it's a pretty simple one, but a lot of people do forget about it. Depreciation may be able to help you increase the negative gearing on your property and accelerate your tax savings. Look, it does depend on the age of your property, but many properties can have depreciation claimed on them. Generally, the best way to work out how much depreciation you can claim on your property is to get a depreciation schedule done by a professional quantity surveyor. In my experience, you really get what you pay for with these depreciation schedules. You can get some online where they don't view the property or anything. They're a lot cheaper, but the quality of them is nowhere near as good as someone like, for example, I've got BMT and Deductible listed there. Look, I mean, we don't have any affiliation with these businesses. We've just had good experience with using them. So usually when clients ask me who they should use, I refer one of those. You'll also find that both of these businesses will speak to you freely about your property before you pay them for the schedule to help you work out whether the cost will justify, whether the benefits that you're going to get from the schedule will justify the cost of getting it done. And both of them will tell you if it's going to be more expensive than the tax you're going to save from getting the schedule, they'll tell you not to do it. So there's really not any risk with having a discussion with them. And the next point is about a change which happened a few years ago now, back in 2017, but it's commonly forgotten about. When you buy a rental property which was previously owned by someone, either as a home or rental, you can no longer claim depreciation for secondhand depreciating assets in certain circumstances. So for example, let's say I replace the carpet in my home and I move out and I sell you my home. You buy the home and you immediately rent it out. Even though the carpet is brand new, you can't claim the depreciation on it because you didn't own the asset when it was first installed and ready for use. Now, this has somewhat limited the benefit of depreciation schedules for existing properties. But again, the quantity surveyors know about these rule changes like BMT and Deductible, for example, and they'll guide you on a cost benefit of getting the schedule done. Another common mistake or misunderstanding is in relation to the difference between capital allowances, depreciable assets and repairs. I'm not going to go through each one of them in detail. There's a quick reference chart here in the slides which you can look at later. And this just comes from the ATO website. But in brief, really, the easiest way to think about it is if you are doing something that's structural or permanent to the building and it can't really be removed, it's probably a capital allowance. If you're repairing, if you're just fixing a small part of that item, like if a fence, for example, is damaged and you just fix part of it, it's probably a repair. But if you're going to replace an entire fence, for example, or if you're going to put in a new fence that's improved in some way, it's probably either a capital allowance or a depreciable asset. The next one that's often forgotten about is forgetting about borrowing costs or actually deducting them in full. So borrowing costs could include loan establishment fees, might include lender's mortgage insurance or LMI. It might include mortgage stamp duty, and that's stamp duty on the mortgage, not stamp duty on the property itself. Could include title search fees, valuation fees for loan approval, etc. So when you add all of these items up, if they're under $100 or less, which does not happen very often, to be honest, you can actually claim the deduction in full in the year that the loan is established. But if they're over $100, you need to amortize and deduct them over a period of 5 years or the life of the loan, whichever is less. So if the loan is established, if a loan is established partway through a financial year, you then also need to apportion the deduction based on the number of days. And if the loan is repaid early, you can claim the balance of the unamortized amount, which you haven't yet deducted. The next one is about capital gains tax. So this one's quite complicated and it could easily run like a whole hour on its own. So I'm going to be relatively quick on it, but there's a lot of facets to consider when calculating capital gains tax on the sale of a property. When you sell a property that's only ever been used as a family home, it's pretty easy. You won't pay capital gains tax because of the main residence exemption. But let's say, for example, you start renting out that family home and you move into another place which you only rent. Even though you've rented out the family home, you might be able to use what's called the 6-year absence rule to make the eventual sale of that property exempt from CGT, or at least to minimize the capital gains tax when you sell it. Using that same example, what if you don't decide to rent another place when you move out? What if you actually buy a place instead that you're moving into? In that case, for the old home, you can use that you're now renting out, you can use the home first used to produce income rule. So with this rule, you get a market valuation for that property that you're now renting out, that used to be your home. You get a market value of it at the time you started renting it out. The higher the market value, the less capital gains tax you're going to pay when you eventually sell the property, and so you'll pay less tax. The home first used to produce income rule can also apply in the previous example I gave, where you were just renting somewhere else, if you're going to be renting out that old family home for more than 6 years. One thing to keep in mind with this valuation method is it's only available when it's your family home first and then a rental property second. If it's a rental first and then becomes your family home, you can't use this method, and you instead need to apportion the capital gain based on the number of days you owned it as a rental versus the number of days that it was your family home. Another capital gains tax exemption or concession is if you've owned the property for more than 12 months, the capital gain will also be halved by the 50% general CGT discount. To complicate things further, there have been a number of rule changes for foreign residents, that's foreign tax residents, over the years in relation to all of the above capital gains tax rules and exemptions. The 50% CGT discount, for example, was removed for foreign residents from the 8th of May 2012, and the main residence exemption and 6-year absence rules were removed for foreign residents for properties sold after 30 June 20. How all of these rules interact with one another is quite complicated, and so you should really seek advice from an accountant who understands them and how they can be used to minimize your tax when you sell. And lastly, a common mistake that we see people make is they forget to keep records from when they actually buy a property and when they then sell it. So you're actually required to keep the records of the purchase and the sale of the property for up to 5 years after you sell it. So you could have bought that property 10 or 20 years ago, and you still need to have those records from when you bought it for at least 5 years after you've sold it. Our recommendation generally is it's best practice that when you buy the property, you should get your accountant to calculate the cost base of the property in that same year when you easily have access to all of the records. Don't just leave it and calculate it when it comes time to sell the property, maybe 10 or 20 years later, and you suddenly can't find any of the records anymore. So, oops, sorry, skip the slide there. So this one is not really about buying an investment property, but it's more about people who decide to rent out their family home via a platform within the sharing economy. Some common platforms are Airbnb and Stays. Some people might do a short-term rental for their home whilst they go on holidays themselves, and they don't really think about the fact that not only do they need to declare the rental income in their return, but if they if the ATO see that, but you also are subject to capital gains tax, albeit a small amount, when you eventually sell the property, even if it was your family home for the entire time that you owned it. So the ATO have been making contact with businesses like Airbnb and Stays to obtain information about everyone who uses their platform, and they then data match that information back to your tax return. And if they see that you are using these platforms and you didn't declare the income from the rent, or you sold the property and you didn't declare the capital gain, then they may do an investigation or do an audit. So I'm not saying you shouldn't use Airbnb or Stays or anything. I'm just saying to be aware of the above, and when you're making a decision about whether to rent your home out, just consider these implications as well. So that's all for the mistakes. From a legally reducing tax perspective, look, we've covered off negative gearing and depreciation schedules and should you buy in a trust or whatnot. And we're going to go through maximizing debt, deductible debt versus non-deductible debt on the next slide. The only other item on here really to make sure of is to make sure you claim everything that you legally can. I'm not going to go through and list all the deductions now, but there's some links that we'll send out when we send the slides. The first link is the ATO's rental property deduction page. It lists all the deductions. And the second link is a link to the ATO's guide for rental property owners. There's tons of information in that one about deductions. So if you're really keen to maximize your rental property deductions, you should familiarize yourself with these or speak to an accountant with a strong property background. Overall, just use this slide as a checklist of things that you should consider to make sure you're maximizing your tax savings. And the final slide is about structuring debt to make it as tax efficient as possible. I'm sure that many of you already understand that there's deductible debt and non-deductible debt. Deductible debt might be debt you take out in order to buy a rental property, and non-deductible debt might be debt you take out in order to buy your family home. It should be obvious from a tax perspective, you want to maximize your deductible debt and minimize your non-deductible debt, because you can claim a tax deduction for your deductible debt and you can't claim one for your non-deductible debt. But the first thing you should really understand is it's not about what property the loan is secured against, which makes it deductible versus non-deductible. You can have a loan secured against a rental property, and if you use the money from that loan to go on a holiday or something else personal in nature, that debt is not tax deductible. It's actually the purpose of getting the loan and what you use the money for, which determines whether the debt is going to be deductible. So if you get a loan, even if it's secured against your family home, but you use it to buy a rental property, that debt will be deductible. So the first step with making your debt tax efficient is to maximize the tax deductible debt when you buy the property. As an example, let's say you've got 400 grand in cash and you buy a property for $1 million, including all of the additional costs of purchase. You put all of that 400K into the purchase of the property and you get a loan for the remaining 600 grand. If in the future you want to use that 400K for something personal, like buying a family home, and you increase the borrowing against the rental property to extract, say, another 200 grand and bring the loan up to 800, that extra 200 grand won't be tax deductible, even though it's secured against the rental property. And again, that's because the purpose of that extra loan won't be to have bought an income producing asset. It would be to buy the family home. The tax deductible debt for that rental property in the example is never going to be more than 600 grand, unless you're like borrowing to improve the property or something of that nature. So when you're buying that rental property, try and maximize the debt that you can get as much as possible to keep as much liquid cash as you can. You can then put the excess cash into an offset account if you want to save interest on the mortgage, but you still have access to the funds should you need them. Building on this point of maximizing the tax deductible debt, this is particularly important. You might decide that you want to use the equity in your family home to help fund the deposit or stamp duty for the rental property. So for example, you might have one loan through one bank, say 80% of the rental property secured against the rental property itself. And you might have another separate loan through a separate bank for 20% deposit secured against your home. Both of those loans would be tax deductible to make them as tax efficient as possible. And they wouldn't be cross-collateralized or anything which can complicate when things come time to renegotiate. So the next point is about quarantining tax deductible debt. This is particularly important in the example I just gave above of borrowing the 20% deposit against your family home. What you should not do is have one loan for your family home and redraw available money from that account via a redraw. So if you do that, the loan will have debt in it that's partly deductible, which is the 20% deposit part, and partly non-deductible, which might be the remaining amount from the home loan. This will make it really hard to track how much of the debt is deductible versus non-deductible and how much of the interest you can or can't claim. It can also dilute over time the amount of tax deductible debt, because every time you put money into the loan and then draw it out again for personal use, that is going to reduce how much of the loan related to the property and reduce how much you can claim a tax deduction for. So if you're going to have tax deductible debt, make sure it's quarantined in its own loan account, separate from your non-deductible debt. So in our example, it would have been a lot better for you to get the bank to make a separate loan or a line of credit that's secured against the family home to be used for the 20% deposit. That way you know exactly how much of the debt is deductible. And you can also ensure that any excess money or redraws only happen from your non-deductible debt account. Interest versus principal, look, it's pretty simple, this one. If you want to, from a rental property and in tax perspective, if you want to keep your deductible debt as high as possible, you want to try and make sure that your loans are interest only. So you're only paying down, so you're not paying down the principal. If you have excess cash, you might use it to pay down your non-deductible debt, like against your family home, or you might park it in an offset account or something. And offset accounts, one of the things to check and make sure is just make sure that the accounts are all allocated against your family home loan first. Make sure that none of them are parked against the rental property loan. You don't want to be minimizing the interest on your non-deductible. You don't want to be minimizing interest on the deductible loan. You want to be minimizing it on the non-deductible loan. And debt recycling strategies, look, just very briefly, let's say you've got cash and you're going to buy a rental property. The bank may be happy to lend you money to buy the property, but they also want you to use the cash. So rather than just putting the cash into the property, one thing you could do is you could put the cash into the family home loan and then re-borrow it through a separate loan or line of credit to buy the rental. And the bank will be happy because you haven't actually borrowed any extra money from them. You've used your own cash to buy the property, but you will have paid down your family home loan first, which is the non-deductible debt, and you'd instead be recycling it to buy the property and making it deductible debt. And that's it from a tax efficiency perspective from a debt for debt. And that's all I had to cover off, Rich. So if you want to jump back on, there's a bunch of questions on there.
Yeah, fantastic. Thanks, Kieran. If you can just unshare your screen and just put us all back on. That's wonderful. Look, thank you so much. We've got quite a few Q&A. So look, thank you so much for hanging on. We'll just rip through these questions. And Mark and Kieran, if you can just give really short answers. What I'll do, a lot of these questions have already been answered. So I'll just pick out the ones that we haven't addressed yet. So Mark, one for you. We're looking for a mortgage broker. What should someone be looking for? Someone who's more investment focused or just writes a lot of loans?
I think if you're looking at investments, you need to look at someone that's got experience with that kind of lending. You might come across someone that does a lot of owner occupiers. They may not have the skills or understanding of an investor and what they require.
Yep, great, fantastic. Okay, another question I'll just go to this one. Is it better to borrow on an interest-only basis or principal and interest basis? I think you've kind of answered this already, Kieran. I know from my perspective, when interest-only loans got repriced, it was actually cheaper for me to reassess them as P&I loans. So I've left a lot of mine as P&I. It just, again, it's not a one-size-fits-all answer. I think it's up to the individual person's tax position. And I'd say get advice on that. Would you agree?
Yeah, no, completely agree. Mark would attest that often if you're getting an interest-only loan, the rate might be higher. So you would really need to weigh up if you get a tax deduction for that. After tax, is it still more expensive than what it would be? And kind of weigh up what else you could be doing with the money, putting it in the home loan, that kind of thing. So it really does depend on the individual circumstances, absolutely.
Okay.
Just, Rich, the other thing I might just quickly add to that is that what they do is when they're assessing your serviceability, if you've got an initial interest only period, they're going to budget you, let's say it's a 30-year loan, 5 years interest only. They budget you repaying it over 25 years and they do the calculations based on that. So everything else equal, you can borrow less money if you take an interest only period at the beginning than if you took P&I from day one.
There you go. Good question. Someone anonymous, how does land tax fit in with this investment strategy, as this was an issue for me in the past? My view on land tax, you've got to try and minimise it, but it's all part of, it's not the only driving factor in deciding where to buy. As Kieran's outlined, land tax is different rates in different states. So often buying in your personal name could actually be a better strategy than buying in a trust name. But again, it comes down to getting advice, and every state has different thresholds. So I just say, again, make that part of your due diligence and get advice from Kieran to advise you on that. One for you, Mark, is rate lock applicable to an expat overseas?
Expat lending is a little bit tricky. So there's a lot of banks that backed right out of that market. And a lot of the banks left in it don't actually offer fixed rate products. So in theory, if there is a lender that will do an expat loan, has a fixed rate product that offers rate lock, yes. But the fact is, in this market, there just isn't. I don't know. I'd be surprised if there's a single fixed rate loan that an expat could qualify for.
Okay, beautiful. Renee's asked, interested on rules around claiming buyer's agent fees on investment property, as my accountant said I couldn't claim. I can answer this one. You can jump in, Kieran, but we write on our invoices a connection between property management and the advice that we give. So there's a connection between the rental income and the advice we're giving. So our other accounts have said around 20% of our fee is tax deductible, but it's 100% deductible as a capital cost.
Basically, in order for something to be tax deductible, you need to be able to show that you necessarily incurred it to derive your income. So what Rich is talking about there in terms of advice in relation to the management of the property in the ongoing rental you earn, to the extent that the invoice relates to that, it could be tax deductible. But he's completely right as well that if none of the advice that you received relates to management of the property, at the very least, all of it would be able to go into what's called the cost base of the property. And so when you eventually sell it, you'll get a tax saving then. So in one way or another, it's all going to be sort of deductible or give you a tax saving. It's just that some of it maybe will be today and some of it may be when you eventually sell the property.
Yeah, great. Awesome. I'll just quickly look through. Is it a good idea to buy a renovated investment property which may be 50 years old at a price a bit higher than a median or old property with 20% below median? Look, there's no hard and fast rule for that one. It's like asking me, do you prefer white bread or brown bread? Brown bread's better for your internal system. I would say don't buy investment property purely for tax deductions. It's the icing on the cake. For me, buying a property in a fundamentally good growth area with all those drivers, and it's going to have sustainable yield and increasing yield, that's what I'm looking for. The tax deductions is coming on top. So it's not about how much tax deductibility it's going to be. Question, someone who's done tax, we've done all the tax, land tax questions. Question, your preference for long-term versus flipping. What's the average length of time you hold properties? Well, I hold forever, as much as I can. My long-term is, unless the only reason I've sold an investment property was when I went to rebuild my own home. And that's just my own personal circumstance. But for me, I would much rather maintain my portfolio and keep revaluing and recycling my equity. That is, draw out the equity to then buy more properties. Otherwise, it's like killing the goose that lays the golden egg. Every year that golden goose is going to lay what's called capital growth, generally speaking, not every year, but most years, and just harvest that. So that'd be my view on length of hold. Kieran, one for you. Is debt recycling generally worthwhile?
Sure. Look, really, we're talking, I guess you've got two ways of looking at it. You can either make it a very purposeful strategy that you're doing constantly, or it might just be as simple as you've got money and you're going to be using that cash to buy a property or like a car, for example, if you weren't financing it, whatever it is, as long as it's something that's deductible in some way. And you literally just take that money and put it into the account that you've already got, a loan account you've already got, and drawing it out again. It's really not, sort of when you say, is it worthwhile? Like, it's not really creating that much extra work and difficulty for you. And if that debt is then going to be tax deductible and you're saving, depending on how much you earn, you might be saving between 30 and 40 cents or more for every dollar of interest, then yeah, it's worthwhile. If it's something that you're really using as an ongoing strategy and it's taking you a lot of time and effort in some way, then maybe not. But generally, I'm not talking about something as intentional as that. But it is something. Yeah. Generally, it's worthwhile.
Okay, which kind of flows into the next question. I'm sort of moving to the chat questions now. Jennifer asks, I'll summarize it, trying to buy 10 properties, time between each purchase, when do you pull out the equity, and trying to buy each property outright. So there's a few parts of that question. For Jennifer's question, you do need a team around you. So yes, you will need a person like Mark on your team to help you get the finance. You're going to need Kieran to help you do your tax returns and give you good advice. You'll need someone like me to help you find the properties. How long between purchases? It just depends on your income and your serviceability as to when you can afford to buy the next one. I mean, my own experience, when someone sat down and showed me the numbers through PIA, property investment analysis, and just crunched the numbers, and I was earning, what, 80K a year at the time when I was working as an economist, I went and bought 3 properties in my first year because I'd almost paid my house off. I had plenty of equity and I had some serviceability. Bang, I went and bought 3 properties. So some of you out there might be able to buy 2 or 3 right now. Others of you can only buy 1. So you've got to assess your borrowing capacity. And then the question, how soon do you buy your next one? As soon as possible. It really depends how aggressive or strong you want to build your portfolio. But for me, there's an opportunity cost of time. The longer you wait, the longer it's going to take you to achieve your goals. So for me, it's just making sure you maintain good buffers and have the right approach. Mark, any further comments on that approach?
No, I think so. Like you said, it's essentially no serviceability. The only other thing I'd say is just look, you can maximize it by getting the debt structured right, and with the lenders that are going to give you the most amount of money or look at your circumstances more favorably helps. And the other thing is, I guess, it just is how it fills in with the rest of your overall wealth strategy. So, you know, you don't want to be going off biting and chewing too much if maybe you've got kids about to hit a private high school or something that you know is coming about. Because like you said, the idea, my personal belief as well, is you don't want to unwind this stuff. You want to be able to put in place, you know, the worst thing would be to buy a property, have it all structured right, and then find you've got to sell it because you've run out of money to do something else. So
Exactly. That's why it's so good to get that structure right from the beginning. Yeah. Someone's asked me, what do I think of granny flats? I think they're fantastic, brilliant way to increase your cash flow. We've done hundreds of them for our clients, so we're very much in favour of them. Another question here. What is the best state to buy an investment property right now? Well, it depends. I can't answer that question without knowing Anthony's personal position. But I guess, you know, from a yield perspective, we're buying a lot in the Brisbane market at the moment, Southeast Queensland, Sunshine Coast, Gold Coast, Brisbane and surrounds. That's delivering really strong yields. But again, there's not a one size fits all. Okay, what's another question here? Would income from shares contribute to loan serviceability? Any income received for giving a loan to my friend? Mark, what do you think of that one?
Generally, if you've lent money to a friend, it's unlikely to be used as income. I think you'd probably say if it was fairly tight on contracts and it was evidenced, you might be able to show it. Essentially, it falls into that investment income. A lot of banks will use share income at a percentage. They like to see, generally it's a 2-year history, and generally they won't use 100% of the dividends, but yes, those sort of incomes can be added onto a serviceability sheet.
Right. Jess has asked, when you mention revalue, rinse and repeat, do you consider selling the property and then buying? No, definitely not selling. As I said, it's about revaluing the property and drawing out the extra equity. And then all of that money you pull out is also tax deductible as well. Simon's asking, I've got a budget of 630 for a first investment. Would a duplex be a good option? Yes, but you can also buy a house for that in a certain area. So a duplex can be a good option. Like I said, we've bought plenty of those in Newcastle and done really well. But again, just depends on your overall strategy, and we'd advise you on that. For Mark, do you have to assess lending applications with a higher interest rate percentage?
Yeah, so I read that question a couple of times. I think I'll try and answer it. It was about the major banks as well. So essentially, and this covers another question down the bottom as well about, can I buy a property without cash flow? Residential property lending is covered under the National Consumer Credit Protection Act and ASIC, and they put in an APRA, and they put in guidances around serviceability. So if you go for a home loan today, where generally the bank has to, under law and their rules and regulations, assess the repayments as if the interest rates were about 5.25%. They've got to add buffers on. So even though you might be getting 2.5%, it's potentially being assessed as if rates were double. So because it falls under the regulation on consumer lending, you start to get into commercial properties and stuff, it can be a bit more flexible. But again, that's usually balanced by the reduced, like you touched on, Rich, reduced LVRs and other buffers that they build in.
Yeah, great. Okay. Is Property Buyer setting up an office in Victoria? Yes, we already have an office in Victoria, so we can definitely help Peter Wong there. What's the other question down here? So we've really covered the land tax. Does land tax calculated based on the land value? Correct. It's based on the land value, not the total cost of the property, just the land content. And the valuer general will have issue a statement every year which will indicate what the land, how the land base is calculated. Can you borrow using husband and wife income, but the property is only under one name? Mark.
So can you repeat that one?
Can you borrow using husbands and wife income, but the property is purchased only under one name?
Yes, yeah, that's generally the only situation you can do it, is when it's spousal. You can use, they're very happy to accept one person on title, 2 people on loan. The only thing you can't do is everyone on title to the property must also be on the loan. So you couldn't have the reverse where you had husband and wife on title, but just husband or just wife on the loan.
Yeah, great. Okay, another question. Kieran, one for you. For the 6-year exemption rule for capital gains tax, how long do you need to live in the property to be considered as a main resident for this purpose?
Yep. Look, technically, there is no minimum. A good rule of thumb that you should use is 6 months. If it's less than 6 months, though, that doesn't necessarily mean it can't have been your main residence. For example, someone might have bought a house and moved in and genuinely intended to live there. And then a few months later, they get a job offer overseas and they decide to rent the property out and go and pursue this job offer. Just because that person hasn't lived there for 6 months, it doesn't mean that they can't get access to the 6-year rule. It might be harder for them if they were ever to be investigated by the ATO. They'd want to make sure that they have all of the evidence to show that they genuinely intended to live there, they had moved in, and then look, here's this letter of offer, it's dated after they bought the property, not like they were offered before, bought the property and then sort of pretended to move in so that they, if it looks contrived like that, you're going to run into problems. But 6 months is a good rule of thumb, but it is not a hard and fast rule.
Okay, great. Yields, this is one from Charles. I think yield in Brisbane has dropped significantly. I don't think it has, but as prices going up quickly, is it still a good time to buy in Brisbane for yield strategy? Yeah, well, as prices rise in any location, naturally the yield's going to drop. But as I said in my presentation, we're seeing a very rapid rise in rents in many locations. And there's going to be a wave of overseas migrants coming and more students coming back. So that will certainly plug the gap and increase yield in those locations. If one property in your portfolio is bad, relating to cash flow and value, what to do? Well, again, it's an individual question. If you do have a complete dog of a property in your portfolio and it's got no prospects of growth, it could actually be time to get rid of it. And I'd be selling it still while the market's strong. But again, I wouldn't be selling it if it's got any prospect of good growth or improvement. It might be it just needs a renovation. It's really an individual question. We're almost out of time. We've got another question here. I'll just jump back into Q&A from Joe. Would income from a commercial property help to unlock equity? I am maxed out with 4 investment properties. Mark, what do you think?
Yeah, potentially. So if that income was filtering through to their personal situation, as in their personal taxable assessable income, then yes, that income from the commercial property can be used. So essentially, if it was held, it depends again, it's going to be very bespoke. If it was held in their personal name, I'm presuming it might be held in the name of a property or a trust. If that was distributing to income to them, then yes, it has a benefit.
Cool. Okay. Look, I'm sorry we're going to have to leave it there, guys, but that's been fantastic. Can I just say to everyone who attended today, thank you so much for attending and listening. Mark Stevenson, thank you so much for your insights around financing. And Kieran Argall from Bell, thank you so much for your insights into all of the tax implications of building a property portfolio. So again, thank you everyone online. We will be sending around a full recording of this, a link to that, and also our notes. And if you'd like to get in touch with Mark or Kieran or myself, our details, contact details will be on that email as well. So we'd encourage you to keep well and safe on your investment journey. Don't make rash mistakes or rash decisions. Please seek advice and be careful. But we wish you a great week for the rest of it and look forward to seeing you online again soon. Bye for now.